Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, December 27th, 4:56 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction. You can see over here on the trend gauge, we track the state of the five major indexes across three time frames and market leaders. Market leaders neutral, holding up, but not really making any progress. Short term, all five of the major indexes are trending below their 21-day exponential moving average. So we're in a downtrend there. Versus the medium term 50-day moving average, we've got a mixed bag. So we're neutral there. Long term 200-day moving average, every index except for the Dow is below the 200-day moving average. So downtrend there with the exception of the Dow. That's what the yellow arrow there indicates. So what happened today? Supposed to be a Santa Claus rally going on, and if you looked at the futures overnight, it looked like that we were following through to the upside on uh, Monday night into Tuesday, but we faded back to flat by the close, and really where we opened was near the high of the day. So basically an inside day for the S&P 500. A little bit of a gain for the Dow. The Nasdaq 100 got hit hard. Tesla again. We're seeing a real-time panic selling event going on in Tesla here, and it's again a warning to never say that you can or never think that you can hold a stock forever. Tesla hit the uh, there's a William O'Neill stat that when leaders top, they fall on average 72% from their high. Tesla hit that level today, down 72%. I think it's closer to 74% now from its high. Just brutal. There's a bunch of bag holders. Definitely not us at Revere. That's not how we handle things. Um, we love a good story, but we love the price action to support it. And when it doesn't, we stay away. So here are the numbers on the day. G6, this is our growth composite, down 1%. S&P 500 down 0.4. Nasdaq 100 down 1.4. Wasn't just Tesla. Apple down 1.4. Amazon down 2.6. Google down 2.1. You get the drift. Dow Jones Industrial Average again showing strength, up 0.11%. Mid caps showed some strength, barely in the positive column. Russell down 0.65, global diversified 60/40 down 0.26 as bonds got hit hard again. In-house GROTECTION, we were positive on the day, 0.06%. We'll go through our trades and what we're holding and our outlook when we hit the tail of the tape. So let's dive into it. Let me first talk briefly about what we do here at Revere. If you're not familiar with us, we follow the trend, meaning if the market is trending higher, we participate in the trend. If the market is trending lower, we either reduce our exposure to the market or just get the heck out of the way, depending on the action. So here's an example of an uptrending market at the end of last year. Playing some ping pong around the 21 and the 50-day moving average, but made highs for the year going into the end of the year. And then the beginning of the year, by the end of the first week, we started to roll over, broke back below the 21 and the 50, and then the slopes of the line started to roll over. They didn't all during December when we were playing ping pong, but then they did. This indicates that we may be entering a deeper correction. We will be reducing exposure as our stops will take us out of the market. It's not our opinion. It's just the price action that's taken us out. And then things really started to accelerate on 118 to the downside with a gap below prior support rolling over the moving averages. 4 straight days down of selling and an undercut of this black line, the 200-day moving average. This is the key level that we pay attention to. Now we played some ping pong along that level for the rest of the first quarter. But we stayed below the declining 50-day, most of the time below the declining 21. We do some re-entering when we get back above these. So we're taking our signals from the moving averages and the slopes of the lines and the action of leading stocks. But this black line is critical. And the key day, I've been saying it all year, was April 21st. try to get back above the 200-day moving average, a big negative reversal. And the reason why that 200-day moving average is such a big deal is because of this chart here. A lot of our clients are either in retirement or approaching retirement, and you cannot afford to take a big hit to your portfolio. This is the nest egg that you've saved 40 plus years for. Our first job at Revere is to protect it and then to grow it when the market is cooperating. You take care of the downtrends or the drawdowns. The upside returns take care of themselves when a healthy market returns. And we document every night on video our opinion of the market. Right now, our opinion as of 2 weeks now has been this negative since this big reversal off a CPI break of the 200-day moving average, which we were trying to get above, but we didn't, and it's been basically downhill since then. We're in about a week, maybe 7-8 day consolidation now under all the key moving averages. So this is day 2 of the Santa Claus rally, the supposed Santa Claus rally, the most fruitful 7-day period of the year in the market on average based on history. The key level that we're looking at, it started at 38.22. If we're above 38.22, Santa Claus is visiting. If we're below it, he didn't show, or he's leaving, or he left without leaving any goodies. But the old Wall Street saying is, if Santa Claus should fail to call, the bears may come to Broad Wall. So key 7-day period historically, definitely something to keep an eye on. And really, we don't talk about season. We reference seasonality. We don't talk about it that much, but you need to pay attention to it because you see it year after year. At this 7-day period it's just bullish, and if it's not bullish, it's usually a harbinger of worse things to come. And we all know how the recession talk is playing out now. So if you're interested in this downside protection, email me, don@revereasset.com, or my partner Dan Stewart, dan@revereasset.com, or call 855 Real Wealth. That's 855-732-5932. So let's go to a 15-minute chart here on the S&P 500. You can see the tight action, basically an inside day relative to Friday's action, which finished near the high after this false breakdown below 3,800 this last Thursday. And now 5 of the last 6 days, we've either undercut or touched this basically, let's call it 795 to 3820 area. Today's low is 3813. So touched it here, bounced, touched it again later in the day, right at 3821 and bounced. Very key area to keep an eye on. And the more you knock on a resistance or a support area, the weaker it gets. And if you don't bounce off of it quickly, a break through it is normally well, it's not normally a breakthrough. If it's not a false breakthrough, it normally indicates that you're going lower if you break it. So that's why we're keeping such a close eye on that 3,800-ish level. That's the S&P. Let's talk about the carnage that is the NASDAQ. Note the lack of relative strength or relative weakness over the last 2 weeks. Santa Claus definitely not visiting the NASDAQ 100. The pivot here is 266.76. We're at 263.58. So bad stuff here. And as I detailed earlier, those NASDAQ 100 stocks continue to take a beating. Let's go to the Dow Jones Industrial Average. We got long on this Friday, and we added to it today, but we can't get above the declining 21-day moving average now. We're adding as a setup for a possible pairs trade here with versus one of the other indexes that we would expect to go down quicker than the Dow if we roll over here to the downside. But this relative strength on the Dow over the last 2 weeks is reminding me of this relative strength that it showed during this rally up in October, late October into the beginning of November, really displaying strength relative to the rest of the indexes, S&P 500, and in particular the NASDAQ 100. So as I said, we're setting up a pairs trade. If this fails, what that does is you'll be long one index, short another index, with the expectation that even if you're in a downtrend, one is going to lose less than the other, and you reduce your risk greatly and stay on the right side of the trend. And it's a low risk way to put a couple dollars in the pocket of clients. Next up, mid caps. Hanging here around the ADMA below. Look at this big confluence here of the indexes, the 21, the 200, the 50, and the 8 below it. That's unfortunately a brick wall above price for mid caps, that area being 450. IWM and continued relative weakness below all the key moving averages after this failed attempt to move above the 200-day moving average 2 weeks ago. So really not a whole lot good to say about the indexes other than the Dow Jones Industrial Average, which is not hit as hard because Apple's in there, but those other high price stocks like Amazon, Google, they've split. But the problem is with the Dow is it brings in a lot of tech stocks later than it should. Salesforce, CRM is an example. They kicked out Exxon, put in CRM. Look at this chart of CRM. I mean, 235, 130, it's down 40+% off of its highs. Meanwhile, Exxon, well, you know what oils have done over the last year, and a gap up and reclaim of the 50-day moving average today on Exxon. How about the equal weight indexes? Let's go to RSP. Not as bad for the last 4 sessions versus the market cap weighted SPY or VU or IVV or SPLG, whichever one you want to use. RSP continuing to show a little bit of relative strength there. QQEW, no relative strength anywhere today, as cloud stocks, software stocks, and semiconductors all took it on the chin today. You can see the the line down on semiconductors. There's just nowhere to hide in tech, and with interest rates resuming their move higher, which I'll now show right here. Let's go to the 30-year. After Jay Powell, we've had 3 gaps higher on the 30-year bond over the last week and a half. TNX very similar. Completely stopped this trend lower in yields and did a complete U-turn over the last 4, 5, 6 trading sessions, above the 21, above the 50 now. We took some small bond positions that we're going to have to reconsider if this persists. What else do we need to? How about a BND, the broad bond index? You can see that going lower. What I showed was yield. This is what's happening with price. There's BND, broke the 21 and it rolled over, coming into oversold territory. TLT was down big on the day, 1.98%. Very much a change. So it's gone from 109.68 to 100 in 3 weeks. So down 10% in 3 weeks. Just when you thought 60/40 wasn't dead because we started, well, maybe was being brought back to life or resuscitated after this move higher in November, we've rolled over now the last 2 weeks, looking like we want to resume that downtrend. How about the dollar? This has played a key role the entire time. Persistent downtrend on the dollar. So dollar slightly down today, but riding this ADMA lower. You see the slope of the line for the 21 and the 50, also a very clear downtrend. But when the dollar was going down, that was a tailwind for stocks, but that has changed totally since the J. Powell CPI moment 2 weeks ago. And if the dollar's going down, what's gold doing? Nice day for gold today. Closed well off the highs, attempted to break out, but reversed, closed in the lower part of its range, but reiterating that it's in an uptrend above the 21-day, up 1% on the day. GDX, we own NUGT, which is 2 times GDX, gapped above the 200-day, pulled back, but did hold the 200-day here. As I said, this is Nugget is what we own. It's 2 times GDX. We got stopped on part of it last week. We're profitable on the remainder of it, and we'll add back if it continues to show strength. NUGT, how about silver? SLV. SLV consolidating for about 2 weeks now, near the top of its range. Gap up, held it, closed mid-range. Note the relative strength on silver. The best of those, better than gold, but precious metals acting well. And maybe it's just the financial terrible financial state that all the world's central banks are in, and the fact that it appears you can't trust cryptocurrencies after Sam Bankman fraud, um, eh, perhaps precious metals getting a second look taken to them. So those are the major indexes. Let's go to the tail of the tape now. Buzz through this correction. We're thinking about taking the put call off of this. It appears broken because of zero dated options skewing the puts and calls, and it just seems like it's not may not be worth it. May have lost its luster or its forecasting or signaling capabilities. So we're considering just taking that off. We're operating under the bear case with the failure of the rally and the break below the 21 on the FOMC 3-day reaction. Some news: China again relaxed their COVID rules for travelers. That popped a share, ASHR, a China Homeland ETF. The day count went from up one to up one with a consolidation day. I mentioned Tesla down 11.4%, hitting the Qs. Holiday sales better than expected, up 7.6% versus 7.1%. Yeah, there's inflation involved in here, but it did beat expectations. Um, I think I don't know if we're back to a good news is good news or good news is bad news scenario. Really, what we're looking for is signs of a soft landing at this point, with the inflation numbers supposedly tamed somewhat. Expectations were neutral coming into today. Yeah, we're below the moving averages, but we are in that Santa Claus rally above 38.22. We had a consolidation day, so kind of a neutral day on the S&P, not the Qs though. And definitely a positive day for the Dow. Let's take a look very quickly at what the Dow pivot is. We're going by last Thursday's close on this. 33,027. We're at 33,241. Not up much, but better than a sharp stick in the eye, some might say. So support held again, this 3,800 area on the S&P. We're between this 259 and 270 support and support resistance on the Qs. Here's the action today. And the closes. Sector's good, but here's bond yields up because bond price is down. Gold and silver good. XME pick. This is an ETF that Mike brought to the attention of the team. It's basically XME without the gold. So if you can either play the base metals companies and then use GDX to focus on the precious metals miners, because XME is a mixed bag and sometimes one area can be zigging while the other is zagging. So really pick and GDX are preferred to XME. Oil strong today, and here's a share. That's that domestic China ETF. Weak. Chucky was weak. That's XLC, XLK, XLY. Those are the three tech related segments of the S&P 500. Semiconductors weak, biotech weak, and solar's weak. Here's our focus list. We'll go through this right before we wrap up. Portfolio, we bought 2% FCX today. Let's take a look at that setup. This is in PICK, P-I-C-K. I'm going to show you 5 other stocks that looks basically exactly like this, which means it's a group move, near oversold with a stochastic hookup. Can draw a downtrend line. It broke that today, and above the 8 and the 21, about as low risk entry as you'll find for anything in this market with relative strength, making a new high before price. So good setup there. And then we added to DIA. As I said, this holding up the best, possibly setting up a pairs trade. Timed it using the 5-minute stochastic when it got oversold down here today, is when we took that 5% position on that. So let's wrap up here. Bottom line, S&P consolidation day on Santa Claus rally, day 2. This 3,800 area, 5 of the last 6 days, it's been touched. It's a huge support area that better not give way or look out below. Let's get now to the focus list, and then we'll wrap it up for the day. What we're still holding 1.5 size on Boeing continues to act well. Mobileye continues to trend higher above the 21. This 8 EMA, a magnet for the intraday action. TMDX bounced off the 50. 21 is rolling over. Volume light. We're about even on this one. NUGT, I already showed that. FCX, we bought that. Here are the other uh, three, really four, that look just like FCX. Vale, good chart there, maybe even better, near the top of a cup and handle. BHP, putting in a handle, relative strength at a new high. Rio, putting in a handle, very nice setup. And here's PIC, that ETF that I mentioned, putting in a handle, coming off of oversold. So good setup there. Caterpillar had a good day today. Uh, remember the failed breakout of 140 last week, pulled back, bounced off the 21. There's your low risk entry, but now up to 243. Nice day on Caterpillar today. On a slow holiday week, good action volume, a little bit above average. Deer also looking pretty good, not as strong today though, just real tight action above the 21. Car, Packer, this is trucks and truck parts, riding the 50 higher, needs to get above the 21. Again, a lot of these names are names that the team discusses in our morning call. Toro, massive shakeout on earnings last week. Uh, day two inside after earnings, poked its head above, uh, and then a move higher today on 25% above average volume. This is nice. TTC Toro looking good. SMCI, Super Microcomputer, continues to consolidate below the 21, but above the 50. We're seeing a lot of triangles setting up like this. Will it break the downtrend line and go higher, or break the uptrend line and go lower? We'll probably find out the first week in January. RXDX continues after its big gap up to consolidate, and volume is drying up. O'Reilly Auto Parts bounced off this 800 area and the 50-day moving average, showing some serious relative strength over the last 2 weeks. Schwab, SCHW, also showing relative strength on this undercut and reclaim of the 50-day moving average. Serious relative strength there. These are defensive growth names that are really looking good. Remember this 12-13 day when a bunch of defensive growth all got sold as money flowed into the heavy, the more higher beta tech. Well, they're all coming back now. Money flowing back into them as they pulled back into resistance. Let's close with FOUR, nice consolidation along the ADMA payment period, processor, and Crocs, CROX. Select retail doing well. Crocs is one of them. Relative strength cooperating. Failed breakout above 100 here, failed breakout above 100 here, but pulled back just to the ADMA. Actually, 3 closes above 100, and now a higher high today. We pointed out because it's strength, you want to keep an eye on something like this, because if the market rights itself, these leaders should lead. But as of right now, things that are poking their head above, it's like whack-a-mole. They get whacked down into the base. So anything that's breaking out is something you want to keep an eye on. That's going to wrap it. As always, love to hear from you. Emails don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much of that you can keep. I say that at the end of every video because it's important. And just, one more look at this chart here will tell you why. So wrapping up Tuesday, 12/27. This is Don Vandenbord telling it like it is from Revere Asset Management. Just the truth, just the facts, no opinions. Thanks for listening and have a great day.